What I want to do really quickly is do introductions and then walk you through a super quick agenda for the call. So I'm Jeremy. I'm the co-founder here at Equilibrium Ventures. I'm the startup guy. I built a few, exited a few, and now I spend a lot of my time learning about capital markets with Itay. Itay, would you like to tell us a little bit about you?
Sure. So I'm Itay. I started formerly at UBS. From there, I launched a wealth management firm, a hedge fund that specializes in options, market dislocations, and now I spend every day with Jeremy as we co-founded Equilibrium Ventures, and we kind of do our thing and have some fun with capital markets.
Very well said. Itay is going to be our main speaker today. He gets to take the lead a lot of times in our calls, and he put together a pretty cool presentation for all of us today. So you'll notice there's no guest speaker, so all of you have to participate. Otherwise, it's no fun, like we talked about. And we kind of have a little bit for the agenda is the bad news is good news. So we'll talk a little bit about why bad news can be good news in the quantitative easing era. We'll talk about some good news on the unemployment claims, and we're going to dig in a little bit on that. And then Itay is going to tell you a little bit more about the behavioral theory of economics versus the efficient market hypothesis. And we're going to really dig into the question, can you beat the market? All right. So without further ado, Itay, you want to tell us a little bit about this bad news as being good news?
Sure. So and by the way, let me apologize for the lack of guest speaker and the fact you'll have to hear my voice mainly throughout today's talk. I know Jeremy hears my voice every day and he gets annoyed frequently. So hopefully it doesn't happen to anybody else here.
It's a positive annoyed. Okay. It's like my Econ 201 t-shirt, I'll just let you do your thing. I'll learn something and it's all good.
All right. Sounds good. So back in the QE era, I'm talking like the QE Infinity 2013 into QE2, all that time. Some traders would remember how bad news turns up to being good news. We get a little bit of a worse employment claim, markets rally immediately. And the general thought is, well, if there is a bad economic news, the Fed's just going to do more QE, which is bullish for markets, etc. Self-reinforcing cycle. And we've seen this play out now as well. Everybody's stunned why the markets rally today. Why is this continuing to happen despite everything? The market just goes up and up. And after the initial shock, well, we've had a long talk about the Fed and how it relates to markets. And we explained the connection between the Fed and the way markets trade. And, this shouldn't be of any surprise to anybody. So,
cool.
Yeah, no worries there. So I wanted to talk a little bit about some of the current stuff we're seeing with the employment figures before we get into the main topic today. And there's actually some signs of improvement in, Jeremy, do you mind enabling
me to share the screen?
Yeah.
Okay, cool. We're going to make Itay the host real quick. All right, it is your turn to run the show, my man.
Sounds good. Okay, so I'll just talk a little bit about the initial claims here for unemployment. Let's start there. Okay. Does everybody see the screen?
Yeah, I definitely see your screen. Give a thumbs up, everybody, if you can see. Thank you all. Appreciate it. Vera, thank you.
So we've seen this before, this chart with initial claims for unemployment, how it exploded at the beginning of COVID. And it does look like we've reached peak COVID. So the new claims for unemployment have been significantly less since the beginning of the COVID period. And the big question is what's going to happen now as far as new claims for unemployment and how much hiring is going to actually take place when states start to slowly reopen. And that's kind of a big open-ended question, but we are seeing some signs of improvement in the labor market. Now, speaking of the labor market, I wanted to go through a few misconceptions and concepts that I've seen there. First of all, we can go here to participation rate in the labor force. So I'm actually on the Fed's website. This is a great website for any econ nerds out there that want to dig into thousands and thousands of charts. They can see that at the Federal Reserve of St. Louis economic data. The labor force participation rate is an interesting indicator that it measures the participation in the labor force from the general population. So we can see this big hit during COVID went from 63% all the way through 60%. And that just means that the current amount of people, so we heard unemployment's at 15%, whatever it may be. So that's out of this number. So out of the 60% that are in the labor force, actively in the labor force, 15% of them are unemployed. So how much of the population is actually working? That's kind of up to interpretation. And if you listen to our calls about demographics, we can understand why that trended up into the 90s and 2000s.
And Itay, and part of that also is that also takes into account people who are retired who aren't looking for work. Is that correct?
Yeah, it takes into account some retired, so some people that are becoming students and things like that. So how many people are actually participating in the labor force? But speaking of, up until 1994, the government didn't calculate it this way. The Bureau of Labor Statistics did a change of the way in which people were counted for the labor force. And what's interesting is that there is this website that I kind of found called Shadow Statistics that provides alternative data to what the real unemployment rate is. So basically what they do is, okay, so before 1994, what used to happen is that everybody was accounted for that labor force, right? And if you are looking for employment, but you can't find it for 12 months, you become what they call discouraged worker, and you just drop off of the labor force. So that's the funny part. If you can't find a job for a year, you're no longer a part of the unemployment data at all. So in order to understand more of the real matrix of unemployment, the shadow statistics actually tells you what the unemployment rate is based on the way the government calculated it prior to 1994. So that gives us a little bit of a better indication to what COVID looked like, or what COVID looks like as far as the real broad unemployment rate in the country.
Got it. So you're saying right now, if I'm looking at this correctly, we're talking 35%. The true unemployment number is about 35% in the country.
Right. But this also takes into account people that are, call it the sharing economy. They have temporary work of maybe 10 or 15 hours a week, and they want to find full-time work, but they can't. Yeah. So that they account in that as well.
Yeah. I mean, I also think it's kind of interesting looking at this graph. If you look at what happens in 2008 after that recession, there's a big uptick. And then more or less during what's considered to be this great 12-year bull market run, that unemployment figure just kind of stays and hovers around 20%. Does this mean that we're going to see some type of new norm of even higher unemployment continued on in the time to come?
Yeah, I mean, I don't necessarily know the answer to that, but if, again, you followed some of the stuff we talked about before, we talked about the velocity of money and how the same $100 that circulate in the economy, how many times it circulates, and we've seen that the velocity of money has indeed gone lower and lower. I would assume that these two would be correlated with one another, because true unemployment or lack of full employment, let's say it this way, some of those jobs that were lost in the recession didn't come back the exact same way.
That makes sense. And for any of you that missed any of those calls where we talked about velocity of money or demographics, just ping me in the chat and I'll make sure to send you over that link so you could see it.
Okay. So just wanted to stop and see if there were any questions related to any of that.
The one thing I just had on there, because it had the U3 and the U6 unemployment, you want to just briefly explain the difference?
Yeah, so that's basically the difference between people that are more on a temporary or a full-time basis.
I just know that's typical for the government. Whoever's in power to always quote the U3 statistics, and the people out of power quote the U6 statistics.
Right, and all of them tend to ignore the participation of the labor force.
And they purposely do that.
I mean, you got to ask yourself, why did the government decide to change the way they count the unemployment rate to make it look artificially lower? Because if we're counting the unemployment rate from just 60% of the population, obviously it's going to be 4%.
That makes a ton of sense. Yeah. And at least, I mean, on the good news side, I mean, we kind of talked about, you know, what we're anecdotally seeing in our own cities. You know, Texas, things are definitely starting to open up again. Rob, I don't know about you in Dallas, but in Austin, there's a lot of people going to restaurants again. I'm starting to see a gradual pickup. And I was also just in Florida, and, you know, a little bit north of Miami, and it, you know, it seems like there's some decent activity happening there. So, yeah, it looks like
things are picking up, but we now have a curfew in the area. So
that's because you've been trying to loot the taco shops at night, trying to get
barbacoa. It's cheap gas and a curfew. I'm back in high school.
That sounds great. And no date. Don't forget about that.
That's great.
Okay.
So basically, I'll hop into the main topic of the call, and, you know, feel free, anybody, if they have any questions, to stop me at any time, because I know this topic could be a little bit academic, but I still think it's important to understand as investors, as we try to invest and, you know, basically make returns on our money, which is, I guess, the reason why we're all here tonight. So I just wanted to talk briefly about this concept of the efficient market hypothesis, and then behavioral economics, and kind of which one is better. Because the main reason we're having this debate is to say, well, can we even beat the market at all? Or should we just invest everything we have in an index fund and just forget about it? And, you know, that's not even look at it. And that's kind of the reason of it. So a little bit of history. The idea of investing in a broad index fund basically comes from this random walk in Wall Street theory. And this comes back to an experiment done in the 1930s. So up until then, everybody believed that experts pretty much know what they're talking about, and they pick good stocks, and that's kind of the way to go. And normal people can't beat the market, but the experts know what they're doing. So in the 1930s, they did this experiment. They took the Wall Street Journal and they put it against the wall. And back then, if you wanted to know what stocks were doing and how they were trading and closing, you actually had to see it in the paper.
I remember those days.
You do? Do they still even have stocks on the Wall Street Journal?
I don't know. Anybody got a Wall Street Journal who wants to share?
I don't know, but basically what they did is they threw darts at it at total random. And as they threw those darts, they said, let's pick up all the stocks that totally were randomly picked. And after a year, they compared it to the top picks of the experts on Wall Street that sit in the biggest offices and make millions of dollars. And guess what happened?
You're going to tell us.
The darts either beat the pros or were pretty much at even with the pros. There was no edge to outperformance at all. And after doing that, there was a lot of academic research going into it saying, like, are these all things just totally random? The things just move in random completely, and people don't necessarily have an edge. And that led to this big thing coming out in the 1950s about the efficient market hypothesis brought by Eugene Fima. So he basically says that there's no point in trying to beat the market, and it's a very simple formula of you take more risk, you get more return, you take less risk, you take less return. And that's really it, because prices just move at random. And the main idea is that everybody has access to the same information. And if everybody has access to the same information, basically all that information is already conveyed into the price. And it takes into a few assumptions that we're all rational players. We all want the best for ourselves. And we're all going to make the most optimal monetary choices for ourselves, which means that we're all completely logical and we're going to do whatever makes us the most amount of money. And we all have access to that same information. So that's the basic assumptions that he refers to when he talks about the efficient market hypothesis. So let's talk about that a little bit. In this efficient market hypothesis, they come up with this thing that, not to mistake with the physics term, this is the efficient frontier. So in this efficient frontier, you can see that there's this direct correlation between risk and return. If you're taking high risk, you should expect high return. You're taking low risk, you should expect low return. If you're below this curve, meaning that you have high risk, but your return was low. So like say, for example, you're having 15% drawdowns, but you only made 2 or 3%. You are not as efficient as you could be. You could achieve a greater return. And being above here, meaning that you're taking low risk and making high return, is simply not possible according to this theory. And there's been this recent study based by Morningstar in 2019, basically looking at all the different funds out there. And they found that in a 10-year period, only 23% of active managers were able to beat their benchmark. So again, they also talk about 10 years of a raging bull market, but nonetheless, if it was a stock picker trying to pick stocks and compete against an index, they failed to beat the index. So it is this piece of information that the majority of people up to only a quarter were actually able to beat their index. So
Itay, in your experience, why is it such a small percentage that are beating this index?
So the random walk on Wall Street explanation to this would be simply because it's random. So some people will randomly be better, but it's also possible that some people on Wall Street are just good salespeople and not good traders, and some people are good traders and not good salespeople.
Another explanation of that's always been given is that if people are mimicking the market and trying to maybe get a little bit of an edge, the problem is then they also have their fees. So the fees are being taken out, whereas if you're at home just investing, you're just paying the commissions for the stock transaction.
Yeah, that makes a lot of sense. So you need to beat the index by a certain amount that's over the fees in order for you to actually outperform. And the majority of people just track the index in one way or another.
It's kind of like sports gambling. You got to beat the VIG by a certain percent to, be consistently a winner in sports games. It's not 50-50. It's like 54.5% or something like that.
That makes sense. Cool. Keep going, Itay.
Yeah, so basically what you see later on in the 80s and 90s, there was some groundbreaking research from a couple of guys, Daniel Kahneman, I think I'm pronouncing his name, and Amos Tversky. They actually won a Nobel Prize for this, and they've totally changed the basic assumptions in this efficient market hypothesis. They're basically saying that, being humans, we don't make those logical choices. We're not rational players. We don't do always what's best for us and what's in our best interests. And those are the most basic assumptions in the efficient market hypothesis. So the big question here is, if they're correct, markets do not necessarily move at random. They move based on sentiment and other things that we'll dig a little deeper into it. So what I wanted to do today is basically go through a deep look of the theory of behavioral economics and go through all the different biases that people have. So it's almost like a behavioral or psychology class than an economic one.
Let's get into psychology. It's been a while.
Right?
Yeah.
Okay, so I'm going to go here and enlarge this. So behavioral economics is where, again, psychology and econ meet up. And I want to talk a little bit about the principles of behavioral economics. So the classic efficient market hypothesis says we have an economic mind at the end of the day. We know our preferences. We will look at all the alternatives in order to find the best decision. We'll make the rational choice, and we will pursue whatever the highest value is in any given situation. But what we find with behavioral economics is that we don't know our preferences. We actually don't necessarily even know what we want. We tend to pick the easy route and not necessarily the best route. And we have a lot of different things that can cloud our judgment when we're looking for the most optimal scenarios. So there are some biases that were discovered in the research and experiments done. This is one of them. So we tend to seek goals, and we have this illusionary feel into into how far away the goal is. So basically, the closer we are to the end goal, the more motivated we are to succeed. So when they were giving a punch card, you buy 10 coffees, you get one free. So when people were given an empty punch card with 10 slots in it, it took 15.6 days for them to get their free coffee. When they were given a punch card with 12, in which 2 were already filled out, it was almost 3 days on average faster for them to get their free coffee, because there's this illusion where they're wanting to get the coffee faster. Next one up, the loss aversion. So this one is extremely important for investors. The idea here is that the pain of loss is significantly more painful than the equivalent pleasure of making a gain. So people will be a lot more motivated to avoid losing $100 than they are to win $100. We can see that in a drawdown in the stock market when we get these 20% and then the panic goes to 37% like we just hit with COVID. A lot of it has to do with the fact that they just want to avoid the pain of losses, and getting money back or gaining money is just not as, the greed part is not as powerful as the fear part. So that's how it relates to market pretty well. And I'm sure a lot of people that have experienced these things will know that's pretty much the case.
Itay, in the book you were reading, did they talk about this at all? Did they give any explanation as to why we're so averse to loss and pain?
Yeah, I mean, all these things can be tracked possibly to evolutionary development and survivalism. So you're more cautious. You want to avoid taking unnecessary risks that can end up in complete losses. So that's kind of like that's evolution's way of giving you an edge for survival.
That makes sense. Cool.
So this one is an interesting one. I'm sure a lot of real estate agents that may be here will be able to elaborate on this. We tend to give value to something that we own that is greater than the exact same thing that we don't own. So I've talked to some real estate agents before, and they've told me one of the things we have to do when we get a new listing is convince the seller that his house is worth the same as every other house in the neighborhood. But because it's his, he's going to be like, yeah, but I have the greenest grass, or, it's my house. How could it be worth the same as every other house out there? We automatically have this feeling that if we own it, it's worth more, which, in this experiment, people would pay $4 for a cup of coffee, but they would sell it for $6 once they own it.
So they feel their possessions are special.
They feel like their possessions are special just because it's theirs. And that relates to the way people invest, right? If I own Apple, I must have been, it's special now because I own it. So I'm not willing to sell it, even if I should sell it necessarily, or whatever kind of investment, because people tend to start getting married to their choices. And this is a principle of behavioral economics.
So you're about to tell me for the rest of the presentation why I'm really not important. Is that how this is going to go?
Yeah, it's kind of going to go like that.
One of the things I've heard along those lines that right where you're talking about, Itay, is like the price of Amazon and how, it's at whatever, 2,500 now. And that a lot of people almost have an endowment principle view of the stock, that they'll buy a share and said, I'm just going to stick it back. I don't want to, if I sell it at 1,800, I don't want to buy it back at 2,500, but I'll just buy a share and stick it back and just try to let it grow forever and almost look at like it as an endowment stock. It's one of the reasons why they don't cut the price.
Right, because it has, or maybe it has to do with this anchoring principle, which is another one. In this experiment, people were asked to guesstimate the price of a wireless keyboard, which they have absolutely no idea how much it's worth. But before then, they had to fill up a questionnaire, a survey, right? And in this survey, they put their name and then their social security number. So whatever their social security number ended at, so for example, it was 74, people were more likely to be close to those last two numbers. So in that example, if your social security number ended up at 74, they're more likely to be closer to $74 in their guesstimate. where if it was in the bottom, they would give it a low price, which basically says that for absolutely no reason whatsoever, this is what they guesstimate the price to be. And, you know, in the book, and I'm not going to talk too much about it, there's two systems that work in your brain at all times. There's this first system that is very fast thinking, which just gives you an idea of the world and makes you think about things very, very quickly, almost automatically. You don't need to think about it. It's whatever it's in the background, like in the computer background stuff that you have no idea, just always working. And then system number two is where you have to actually work your brain and start thinking and figuring things out. So there's just a lot of times where system number one takes over and people don't necessarily realize that's happening. This is one. So another one is the reference point idea.
And real quick, Itay, before we get into that, I know we've gone through a few examples, and everybody, we do have a lot more examples to come. Do you guys have any questions so far about any of the biases that we've talked about? Or maybe any examples of things that you see in your own lines of work that relate to any of those previously mentioned ones?
The one story, Itay, that I heard a guy that was actually dealing with
like kind of
estate.
the inverse correlation, just seeing how correlated they are on a minute by minute basis. I think we talked about a little bit before, is that part of it is that SH is a $22 stock, you know, so when it moves 1 cent, the percentage movement is going to be, you know, X amount. And SPY is a $300 stock, and when it moves 1 cent, then the percentage movement is a lot less. You know what I'm saying? So that's. Mm-hmm.
Mm-hmm. Okay.
Yeah,
cool.
it is the case, but you know, it's opposed to SH. You mean that's like the 1-to-1 short for the S&P 500,
that's right? Yeah, I agree 100%. Then I mean, there's also the factor of trading commissions too. I mean, how much that would eat into it.
Right. Well, you're referring to which part?
Got it. We can
Does
come
it
back.
really?
I think we're getting a little connection issue.
How does it do that?
I think
he's not on mute, and he's.
Yeah.
I never heard of a stock doing that.
Oh, okay.
Oh, yeah. Maybe we just want to.
I think he's having another conversation.
I mean,
I think that's Sam. Can you?
All right, I just muted him. I think we just intervene into it. He's having another conversation about SH and why is it acting that way with the S&P. So
okay. Well, we took our.
It's also a behavioral economic thing, but that's just a pure math one. So I'll go into this one real quick. The reference point idea. So this experiment was done again to show that people don't necessarily always make the logical choices. They're sitting on the beach. It's a hot day. A friend is going to get a beer for them. And people are willing to pay totally different prices depending on where the beer comes from. It's the exact same beer. It's the exact same result. Are you sure
that's not an average price? That like when you say you execute.
Can you kick him out of the room, please?
Yeah, he's muted.
Okay, got it. Well, he came back on mute again, so.
Yeah, I'll next time I'll do it. So that was strike 2. Strike 3 is usually the one you kick him out, right?
Yeah, or strike 2, either one. Okay. Eddie's saying 3 strikes and he's out. Next time he's gone. All right.
Okay. Sounds good.
Keep going.
So basically, the friend goes and gets you the beer. So based on where he's going to, you're going to be willing to pay totally different prices. You're willing to give him a $4 budget at just a convenience store and a $7 budget if he goes to a hotel, which is kind of interesting. Talking about preferences. Go to the next one.
Were those average prices though? I mean, are those?
Okay.
Itay, he's got to go. Kick him out. Boot his ass out.
Come on, this is funny.
He's out.
No. This is. I'd rather have somebody's cute dog interrupt than deal with this crap. Okay, I have zero patience for it. So Itay, kick him out. And
sounds like he's out. Sounds like I understand his occupation pretty well.
Yeah.
Okay. So I won't go too much into this one. This one's a little bit complicated.
Peaceful protesting.
All right, all right, all right.
Okay, so this one is basically just talking. The framing is goes back to the loss aversion. This is another way to talk about this loss aversion. So people react totally differently by the way an option is presented, right? So 93% of PhD students registered early when there was a late fee, where there was a penalty for late registration. So if you registered past this date, you pay an extra $10. But if they were given a $10 incentive for registering early, only 2/3 would do so. So the loss aversion is so much stronger. Literally 93% would avoid the penalty versus only 67% would go for the discount.
So you're trying to tell me that when I'm trying to do sales reach outs, really hit my loss aversion more so than my ability to win something?
Well, that's what behavioral economics tells us.
Okay.
So the next one is something that I found to be very, very interesting, is we have this notion of perceived fairness. We want our interactions to be fair with each other and with other people we interact with. In this experiment, they give a bunch of students $10 to split. It's an ultimatum game, right? They go in and say, I give you the $10 to person number one. Person number one goes to person number two and says, I'm going to offer you X amount of dollars. If person two accepts it, they split the money and both go. If person number two rejects it, neither of them get anything, right? So person number one, in theory, can go to person number two and tell him, I take $9, you take $1. Person number two should still say yes if he's a rational player, because he's still getting $1. That's better than nothing. And if he says no, both are getting absolutely nothing. So this game has been played out many, many times. And what's really interesting is that if this offer goes more or less further away from $3 from the average, the person will say no and would rather get nothing than something, which goes completely against the efficient market theory, right? Because if a person was rational, he should take any amount of money versus zero. But that's just not the case. Have you ever encountered any business deals that blow up because of something like that?
I see Ruchi laughing. Ruchi, you've had you lost some deals over this?
Never. It's never happened to me ever before. I never deal with any irrational people, especially Indians. They're the most fair people you can ever work with.
He's Indian, everybody, so he can say it, okay? Yeah. Well, we have a deal actually right now with a guy who is not being the most rational either. So we'll see how that goes.
I had this happen with scalping tickets at a college football game. Had a guy that was selling tickets, and they had TCU just gone into the Big 12, so the tickets had gone, skyrocketed to like $65 a shot. And there was a guy selling scalp tickets that the police kicked off, and so he wasn't going to be able to sell his tickets. And I followed him for about a mile, so he's a mile away from the stadium. There's no one else around to buy his tickets, and he has 3 tickets. And I offered him $20 for the 3 tickets. I was starting my negotiation. 20. I was willing to pay him $50 for the 3 tickets. He was trying to sell them for like $50 each. And but I said, hey, I'll give you 20, because I said, you're not going to get anything out of it. And he looked at me and he said, I'd just rather take nothing, turned around and walked off. And we didn't go to the game. My kids were pissed.
Wow.
Yeah.
So that's real life example of the fairness principle. When people feel that something is just unfair to them, they would rather take nothing, which is just something interesting, right? Because it goes against the concept of rational economic players.
That's very true.
So,
hey, Itay,
yeah.
Sorry, quick question. So do you see that with a lot of market related stuff too? Because if somebody buys an option or a stock and it's already gone down X amount in value, then if there's an expiration date coming, then it's like, well, I've already lost 60, 80%. It's like, maybe it'll just go up. Like, can they
it's one of the most
rather
common.
Lose it all at that point.
Yeah,
right?
It's literally one of the most common investor mistake, especially with options. If they buy like a call option or something like that, they don't realize that the time decay eats it away, and then it didn't go their way, and they lost 50 to 60% on it. Instead of just closing the position and using some money that's left, They're already at the point of like, it's not fair. The market's disappointed me. Everyone's against me. I'll just let it go to zero.
Itay, are you also, in going through all these descriptions here, you're really talking about Nash's theory of economics?
I'm sorry, Rob, you were cutting off there.
When you're going through this, it kind of reminds me of John Nash's theory of economics that he won the Nobel on.
Yeah, that's builds on it. I mean, there's a lot of stuff that's in common here. This is a little bit different just because it's purely on the behavioral side. So this one's a little bit interesting. The hedonic principle, or the luxury principle, they call it. So people don't, again, comes to the idea that they don't value things correctly. When given choices of a cash reward that is significantly higher in value, let's say a $10,000 reward versus a luxury cruise in the Bahamas that is only maybe worth $3,000, people would take the cruise. And that's because the monetary value is not given to them, but the idea of like, they're selling the idea to them, you're going to be in the Caribbeans, you're going to have great food, you're going to have a great time, you're going to go to the beach. And that's just so much more appealing than money. And that's been proven time and time again. And that may explain why some companies give these vacation packages as bonuses and rewards, because they're actually a lot cheaper to them than actual money bonuses.
It works for all the salespeople all the time. You're going to go on the company trip, you're going down to Cabo, and you will stay 4 or 5 days in a beautiful resort. One other thing too, real quick, Larry actually just brought this up. These principles are more in line with the book Influenced by Robert Cialdini. I can tell you firsthand that book definitely changed my perspective on sales and negotiation, and I highly suggest taking a look at it for anybody that's there. Influence is an incredible, incredible book.
That's awesome. Okay, this is another one that refers to the idea that we're all special. So this is a study done with credit card companies, which looks at the likelihood of joining a credit card program. So here, if it was presented as you get double points for all grocery stores and gas chains, the likelihood of joining was not very high, around the 3 mark right there. But if you get to pick your grocery store that you like, and you get to pick your gas stations that you like, your favorite brands, the likelihood of joining the program will be significantly higher, almost 3 times higher than literally all of them. People would rather, by a magnitude of ×3, choose the one that they pick because it's unique and catered to them, which again goes back to, we all want to feel special.
Cool.
This one is also kind of interesting, and I'm sure a lot of investors are going to relate to this as well. The feel of misery and then the likelihood of making mistakes that follow from the exact same outcome, right? If you miss your connection by 45 minutes, you're going to be pretty disappointed that you missed your flight, but you still missed your flight. It's okay. You'll catch the next one. If you run, the gate closes a minute before you get in and you miss your flight by a minute, you're going to be very, very angry. The outcome is the same. You still missed your flight. It's the exact same flight. You're still going to need to do the exact same thing, and you're still going to need to book that flight. If you miss that trade by 3 days or 3 months, you still missed that trade. There's absolutely no difference. The outcome is the same. But now your psychology is going to tell you to do a lot of really bad things out of regret, and you're going to make a lot of mistakes. But there's absolutely no reason for that to happen because it's the exact same event and the exact same outcome. And you still want to tell me we're all rational players?
I started off today thinking we were rational, Itay, but you are slowly changing my point of view.
Actually, I got to disagree with that last one though.
Okay.
Like, in the reason in specifically that example is if I'm like 1 minute late or like I'm right there, I'm going to sprint through the airport, and now I'm sweaty at the gate. I mean, I might be just like splitting hairs, but there's a very big, if you're like, I'm an hour late anyway, I might as well chill out and like get a beer or something. That's a different animal. I don't know, like maybe I'm splitting hairs, but I don't agree with that analogy.
So let's talk about a different example. Let's talk about you had a rebalance that was going to take you from stocks to bonds one day before the COVID crash. And
where did you get that example from?
so you missed it by a day versus you missed it by 3 months.
Or just put yourself in like a taxi. You got no control. You're just sitting there waiting.
Yeah.
I still think the flight example applies because you're right. If you're running through the airport, it maybe changes the dynamics. But what if it's a connection and your flight pulls up to the gate, 45 minutes late and you miss your connection versus your pull up to the gate 1 minute late and your flight's at the next gate? You'd still have that same difference in reaction, I think. So
that's a fair point. So, but thanks for that. That's great. Okay, this one's kind of interesting. I thought that one was really interesting. Called the decoy effect, just how people easily get confused. So a bunch of people were given these options in a survey, and this is for subscription to The Economist magazine. By the way, The Economist is pretty awesome. If anybody likes to read, I like reading it. People are given two options. They pay either $59 for the digital only version or $125 for print and digital. And 68% said, well, digital only about a third picked this one. But now when people were given a third option, $59 for the digital only, $125 for print only, and $125 for print and digital, 84% then chose the print and digital because they're like, hey, I can get a bargain for the same price for both. Obviously, I'm going to get it. There's a massive change in how that played out.
This is incredible to see because anybody that comes from the world of tech startups and specifically SaaS solutions, I feel like every time I'm signing up for some type of software product, there are 3 different options. And I feel like this is the complete explanation as to why.
Could very well be. Okay, this is kind of interesting. I think a lot of people that trade options would relate to this. This is there's motivation in uncertainty. So this experiment basically had a bunch of people drink water over a 2-minute time frame. It's a challenge. You got to drink this whole bottle of water in just 2 minutes. And there are 2 groups of people that were tested. One were told, if you drink the bottle of water in 2 minutes, you get $2. And the other people were told, if you drink this bottle of water in 2 minutes, we're going to flip a coin. If it's heads, you get $1. If it's tails, you get $2. So people that were guaranteed $2, 43% completed the challenge. But when there was an ambiguity and they didn't know how much money they're going to get, actually 70% of people did it. And I think it again goes to, I'm special, so I'm going to be lucky, and I'm going to get the $2. And there's some kind of motivation in that uncertainty. And I think a lot of people, I've seen it with traders, they pick their stock, they buy their option. The feeling of uncertainty, not knowing how much money you're going to make, nobody thinks that they're going to lose, right? When anybody opens a trade, everybody assumes they're going to make money on it. But when they do, not knowing how much money they could potentially make is very rewarding to them. And we see that play out in the market a lot in speculation.
Cool. Real quick, Itay, do you want to just quickly ask anybody got any questions?
Yeah. Any questions? Anything on any of it so far?
Okay. Yeah, we have somebody that would like us to share it. I will make sure that you all get a link for this. Okay. So not a problem.
So this is a funny one that again goes back to how special we all are. So people were given the survey, asking them what kind of driver they think they are. Are they more honest, cooperative, rational, and better drivers and more intelligent than all the other drivers out there, right? So 85% said that they are in the top 15% of all drivers. So we're all good drivers.
I can tell you down here in Texas, that is definitely not the case. The majority are not very good drivers.
But if you ask them, that's not what they're going to say. So everybody thinks they're better than everybody else. Everybody assumes that they're better than the average. And that's kind of the way these things play out. So this one, I think is very important for investors to understand. People tend to put a significantly higher value on the now versus the future. So rewards that happen right now are significantly more desirable than ones that happen in the future. When people were asked, would you take $100 today or $110 in a month's time? An overwhelmingly large amount of people would take the $100 today. And it's not linear as well. So the further out it is in time, the less desirable it is. And this is what really blew my mind. When people were asked, would you take $50 in 3 years? Or would you take $100 in 4 years? More people would take the $50 in 3 years.
So Itay, if this is so evidently known, how can somebody use this to their advantage as being an investor?
I think planning for the long run and being able to execute on business plans that span multiple years, not necessarily getting your rewards today. That's one of the reasons you're able to do that in the markets, because the vast majority of people just fail to comprehend the future to that degree. So, there's a reason I think Jeff Bezos is the richest person in the world, because he was able to plan for 15 and 20 years ahead.
Do you think maybe trying to find something like this would be like finding a company that's much heavier as a percentage of R&D spend versus other of their competitors, as maybe they're using that to think about the long term?
Yeah, I mean, companies with like legitimate 5 and 10 year plans, like that explains why our political cycle is so short term and things like that. People just, at the end of the day, people care about the here and now significantly more. And discounting for the future is just not something humans are that good at doing.
Right now, with everything going on, one of the hedge fund managers is the number of companies, they're shoring up their finances, but they're firing a lot of engineers and the creative people and the R&D just to survive, which may help them in the short term. But then the worry from these managers is, where are the products in 3 and 5 years? Because you're getting rid of all those people. And I think we're going to see that play out in a lot of companies right now.
That makes total sense. That makes a lot of sense. So this one's a little fun math one. People get confused by this all the time. Basically, when you switch the category size, people get completely confused. So basically, what is the likelihood of picking a gray 8-ball in these two diagrams? And most people will say, obviously it's in B, but each one of these just has one gray 8-ball. The likelihood is exactly the same. You can only pick one gray 8-ball.
Yeah.
So this one's a little bit more of a tricky one. So there's a few more. I'm not going to talk about them because we don't have that much time. But I wanted to stop this and see if there were any questions about any of
that. I feel like you didn't answer the original question, which is, can you beat the market, right? And like you kind of talked about the evolution of thinking around, the development of modern portfolio theory and why everyone's moved from active towards passive, et cetera, but it doesn't answer the question of like, can you manipulate that efficient frontier successfully?
Okay, that's a great question. So I want to share my screen here because I was planning on doing it anyway and talk about a little bit of what I see in the market that relates to everything we talked about, and then I'll kind of let you answer that. So this thing right there that you can see, let me flip this. This chart that is totally unclear and you don't know what it is. This is the put to call ratio in the stock market on a day-to-day basis. So basically, this can help explain what's driving markets more than anything else. Basically, this means that in equities on any given day, when this line is closer to the bottom part, we have more calls that are traded than puts. And when it's closer to the top part, we have more puts traded than calls. And what I can do right now is just to add real quick a comparison to the S&P 500 to see how it looks like, right? So what is driving the markets? As the markets run higher, we can clearly see that sentiment is definitely going more towards the call side. As the market's crashing, is going towards the put side until it reaches an extreme, and then it kind of reverses. So is it really economic information that's driving these markets, or is just like people pushing it via sentiment? They're getting more and more and more bullish. It reaches an extreme, we kind of reverse. It reaches an extreme, we kind of reverse. So I think what this is saying is that, all right, so I'm going to let you answer it. So what do you think about it? Hey, Tori.
Tori, you're on the spot.
I'm muted.
He turned this around on you.
About what do I think about what? About this chart specifically?
You're my hero.
about the idea of whether or not you as an individual can pick the market. But remember, 85% of us are good drivers.
Well, do I think as an individual you can? Probably not. But I'm coming from or actually, I don't want to throw us too off base, but I have a second follow on to that answer though.
Yeah. And what's the second follow on?
Well, I believe it can be done because I mean, like what leads me to believe that is like the fact that, you know, Rentec, like for example, the Medallion Fund, what is it? The annualized returns for like,
40%.
you know, since 88, no, it's the annualized returns are 66%.
Unbelievable.
After all fees.
After all fees. Yeah, after fees. And so what
which by the way, they're 4 and 40, the highest in the industry. So their real return is almost triple digits.
Right. So it's like, would not the rational thing for any market participant be do whatever it takes, form whatever vehicle, get whatever you have to do to like get your money into that fund?
It's closed. It has been closed for 20 years.
I know. I mean, I know that, but
we've seen. I think the conclusion is that there's probably some truth to the efficient market hypothesis. Markets are efficient to a degree, but I think we've seen it also with some kind of people that were able to do it. Edges can be found, and investors can do well over time. I'm not going to necessarily say you can beat the market because not necessarily anybody can, but it is something that I think is possible, that can be done.
Yeah. So the answer is yes, it can be done. Whether you can do it is very questionable. Sorry, when I say you, I mean the proverbial I or we.
I completely understand. What do you guys think?
Well, what I kind of took away from it was it started out with the assumption that people are like perfectly rational. And you just spent like half an hour breaking that, like destroying that. So the conclusion that like, therefore there's no edges, kind of dubious, I guess.
Yeah. So I've got a take on this. And I think that, you know, you started out with the example about the dartboard versus the analysts. And one underlying feature of that comparison is that you were looking at a relatively long-term buy-only situation. And I think in that scenario, it is almost impossible. And Rob was right. You're going to have slippage, and you're going to have commissions, and you're going to have all kinds of things that put you at a negative edge right from the get-go. But even if you take those things out and you just look at the beginning portfolio versus the end portfolio, it's going to be very difficult to beat that, I think. But I think there are techniques, and it does come to the human behavior. And I am a big Kahneman and Tversky fan, because I think it is about, you know, it's supply and demand, but I think fear and greed are the same thing. Supply and demand, that's what I think drives markets out of balance and finds inefficiencies. But I think the longer term you look at, the more difficult that would be. And then potentially there's the really short term, it's all, you know, randomness maybe as well. So there's some sweet spot in there where you can measure the emotions of the market, where people do start second guessing whatever they've been doing, whatever their analysts told them, whatever their models have told them. And that's when things can move. And if you're a keen observer of human behavior, you might be able to find an edge there. And that can be done through, you know, it's like through psychology and a lot of techniques you've talked about and you're studying, or it can be done, in my opinion, by studying the price behavior, because it's baked into that. And that's, you know, technical trading, the foundation of technical trading, and being able to use it in a way that measures the emotional impacts of the participants in the market. And in my opinion, in 30 plus years of trading, that can be done, and it can be done pretty reliably if you yourself as a trader keep the emotion out of it. But I think of that as more of a trader than an investor. The long-term investing, tough to beat, tough to beat a benchmark. That's my 2 cents.
There's an old trader's axiom that says the crowd is right during a trend and wrong on both ends.
Mm-hmm. But you can make money, even with that, if you understand what the crowd is doing and you jump on that trend when the crowd is right, you can be on their side and still make money. You just have to know when they're going to be wrong or when they start being wrong. And you can see that again through the emotions in the markets, I think. Not all the time. Maybe it is at 52% and that makes you the winner.
That's
I
enough.
think one thing that Itay showed early on when we started doing this series about the VIX, usually making an extreme about 5 days, somewhere around there before a major market bottom. That was like one of the first sessions you ever did, as far as trend changing, that type of thing.
Yeah, I look at volatility as a good way to tell me what's going on.
Itay, I kind of liked what Paul said here. He said, how can the market reach efficiency if there isn't at least one person out there finding the arbitrage to bridge the gaps?
Well, the efficient market hypothesis says arbitrage is not possible, because if it was possible, people would do it and hence it would disappear.
Right. The act of doing it makes it go away. So it is possible, but it's short term.
Or it actually, like, how could it be possible in a continuous term? Because then it would just go away.
Right.
Well, that's kind of like contradictory though, right?
I mean, it's yes and no, but the act of having an arbitrage would also make it go away. But we know that people like, Michael Milken made billions of dollars off of arbitraging junk bonds. But that was in a time where, so it is to say computerized trading and things like that have definitely reduced the amount of arbitrage that's out there. So it's not as easy to find, but we have, the Flash Boys kind of stuff that they arbitrage stuff on an extremely nanosecond scale. And they, what was the name of that firm? Virtue Trading or something like that. They went through 1,700 trading days with losing money in just one day.
That's crazy. That's crazy.
What I'm seeing from a mindset standpoint is that people have to use their instinct in order to compete in this market. If you don't trust your instinct, you're not going to succeed. You're probably better off staying out. But by the same token, that same person with polished instincts also gets emotionally triggered. So something might have happened in their personal life completely unrelated to their trading strategy or the markets, or they might have had a bad experience with the trains and the train stock is doing something. Whatever that connection might be, that's triggering them in that particular situation. If they're not aware of it, that will also be a sabotaging factor. So a lot of it is not only what's going on in the sentiment in the market, a lot of it has to do with how am I as an individual getting triggered by all of this activity, and how am I being impacted by the last trade I've made? And do I feel like a winner? Do I feel like a loser? Do I feel confident? Do I feel weak? All of those little nuances also play into how successful you can be short-term or long-term.
And that is a super important, I think, super interesting point. I know Faraz, if he's on here, is a professional poker player. And Faraz, if you're there for a second, they were just talking about, hey, how does the things that happen to you, maybe in your world, would be when you're playing at a table?
Yeah. So is my audio okay?
Nice haircut, by the way. We're loving it.
Quarantine mode. Funny thing that happens in poker is a lot of people refer to hot streaks, and then people that are smart say, well, hot streaks aren't real, but I actually think they are real. But what they are is you play more confident when you're winning. You make better decisions. You're able to trust your instincts more, and I think that's super on par with exactly what she's talking about. And yeah, it could apply to business, to the market, to many other things as well.
What happens when you lose a big hand? What types of pitfalls do you normally see from players that can kind of
Yeah,
kill?
so lots of times when you lose, a big hand, some people become too conservative. Some people get too splashy. They try to chase losses. You basically make irrational decisions, emotional decisions. So a good strategy that I always like teach my students is to stay even keel. So like as you're winning chips, don't get so excited. Don't start bragging. Don't start celebrating too early, because the faster you go up, then the quicker you're going to go down as soon as something bad happens. And I think that's super relevant, in startups and business as well. Someone has a good deal going, they start getting overly excited, some bad news happens, and now you're having these huge emotional up and down swings.
Mm-hmm.
Got it. And Faraz definitely knows what he's talking about when it comes to poker. He's one of the more well-known guys in that world. So he's learned a thing or two around the years.
Yeah, and I think
learn the hard way.
Yeah, I totally relate to that. So when a trader loses money in the market, they have this feeling that they're out to get you. Like the market wanted to go down that day just for you, just to screw with you. And people, as unrational as that is, that's a very common thing, which I'm always surprised. It's like the second I make a trade, it reverses on me.
But it only wanted to go right to your stop. That's the way it works.
Yeah, exactly. It went right for my stop, and then it turned back the other way.
The world revolves around us. Like, we know that, right?
Right.
Because we're all good drivers.
And the funny thing is, we all know we can't win every hand, right? Statistically, that's not realistic. So if we place 70% of our trades correctly and have success, that 30% makes us feel more of a failure than the 70% of the wins.
That's the loss aversion principle. Losses
Yep.
hurt significantly more than equivalent gains. That's just a part of the trade. So I mean, I found a lot more success once I just automated my decision making to just arbitrary stuff and repeat it in just a process that just arbitrarily happens on just one given day of a week, where I would trade only on Fridays, no other days, and completely ignore the data points in between. And since I've started implementing systems like that, the success ratio went up significantly.
But what's even crazier though is when you think about like my world and a little bit of Jeremy's, where if you're hitting 30%, you're doing pretty well in startup investing, right? It's like, it's a pretty, I mean, and that's just like, you got some of your cash back, not like, knock it out of the park. You're usually looking for 1 or 2 grand slams that like pay back all the other losses. So it's a really, like I'm looking at this from a different lens, and it's funny to hear like 70% winning. it's impossible in startups.
That would be the most fun if it could happen.
Traditionally in book publishing, it's only 10% of the books that actually make the publisher the money back in the day.
That's like movies too.
Mm.
That's crazy. Yeah.
Sometimes. Oh, go ahead.
Go for it.
No, go. What you were going to say?
No, I was just gonna say that I used to know this hedge fund guy when I was living in LA, and they were literally trading. They were investing in movies. That's what they were doing. So he told me that they're making money on like 10 to 15% of the movies, but the ones that hit it, they were averaging 25 to 30% returns per year. So that's their way of beating the market. They found their little niche, and they just do it well.
Speaking of that, my one of the the company that I moved to SF to work for back in the day, the CEO and I are still we still chat, and I was talking to him recently about his portfolio, because his background was as a Wall Street trader, and then he moved into tech and is the founder and all that now. But he it was really funny because he basically a couple of years ago took all of his money out of the markets and has literally something like half of his portfolio is in basketball cards and half of his portfolio is in real estate. And he's made 83% IRR every year since he moved his money into the basketball cards. And I was like, what? And he's like, it's basically like a really immature market, and he understands arbitrage really well. And so he basically just started cornering markets around like certain players. And then the returns have just been apparently insane. And I mean, the whole thing sounded so crazy to me, but like, it's kind of insane. Like he has zero equity exposure. I mean, he obviously has, the majority of his actual net worth is really in the company, but meaning outside of the company, it's all either in real estate or basketball cards. And that sounds insane, but he has like almost what is getting closer to a like 8-figure portfolio in basketball cards. Like it's like shocking. And he has like one of the biggest.
No, but I'm saying he cornered the market on like one specific, let's say, player that he just owns all of them.
Well, there was definitely elements of luck because he started cornering the market on Kobe Bryant. And then after Kobe died, his portfolio basically overnight exploded in value. And he had at the time, like he had of like the top 10 most valuable Kobe Bryant cards in the world, he had something like 8 of them. And so he was able to really take advantage of the market. And I mean, he's just a very sharp guy, but and it just goes to show that it's like, that's a bizarre way to beat the market in my mind. But he also it's funny that he's like this like wildly successful card. You would never think like on the side of like running a Silicon Valley company, he's like also like one of the top card traders in the world on this like just bizarre asset class.
I mean, basically he's a card shark is what you're saying.
Yeah.
Pretty much.
Like, have you ever studied the Hunt brothers when they try to buy all the silver in the world?
Yeah. It's not too different. Like he had one card that he like bought for like $2,000 that later he sold for just under $300,000, like on one card. It's insane stuff like that. Like we're just makes absolutely no sense. It's like completely irrational in my opinion.
So you think we should start trading in the South Korean baseball card market? Is what you're saying?
Yes.
There's gonna be a lot of money in that world. Let's do it.
I don't know if Ryan's on the call, but he told me about this hedge fund or like a CTA guy that he started a CTA that specialized in milk trading, and he like was doing 30% a year, and he was just milk futures. That's like one of the most illiquid futures market out there. And
that's ironic.
He was literally trading milk and making a fortune from trading milk.
Yeah. Well, this sounds like trading places with hog futures and orange juice. I'm gonna corner the what's it, concentrated orange juice market.
Oh yeah,
Randolph.
Turn those machines back on.
I love that movie.
I was actually doing a tour on the CME and CBOT, and I looked down a hall, and there was 2 guys in chairs staring at each other. And I this is a true story. And I asked a guy named Mark Nagel, who's on Floor Trader for years. I said, "What's that?" And he goes, "That's the milk pit." And it was 2 guys just staring at ethat's
one of them.
Yeah, he's one of the 2. Well, they had to use the floor brokers at the time. So
that's so funny.
So then does almond milk start trading in the milk world now, or what? Or is that the nut market?
No, I think it's the nut market.
All right, cool. Well, everybody, we appreciate you all being on. We're going to hang out for another 5 or 10 minutes and continue to do this. So for anybody that wants to hang out, please do. There's absolutely no expectations for the next 10 minutes. It's just a bunch of having fun. Otherwise, we'll probably be back in 2 weeks, I think. Just makes it a little easier for us to get some more in-depth content for y'all. So want to say thank you so much for signing on. And anybody else who wants to hang out, this is the point that we're just going to do our thing. And we'll send out the summary of the deck for you, Tom, and everybody else who wants to see it, and expect it by tomorrow morning, all right?
Awesome.
All the messages. Thank you. You're all great.
Thanks, Jeremy. Thanks, guys.
Thanks, guys. Thank you.